So welcome again. In this particular session, now after having a look over the going concern, now we will have a look over the term accrual basis of accounting. Accrual basis of accounting. I need not require to tell you what exactly it is. Ind AS 1 simply states that entities must adopt accrual basis of accounting for preparing what we call their financial statement. However, for cash flow statement, they can dispense up with this because cash flow statement is prepared on cash flow basis, correct? So, entity shall prepare financial statements using accrual basis of accounting except for cash flow information. Quite obviously, isn't it? So there is nothing much to discuss this particular point. However, one more point I would like to bring to your focus. When we say entity, or when Ind AS says that entity should adopt accrual basis of accounting, it means that in order to recognize the assets, in order to recognize the liability, income or expenses, entity will use the definition of accounting framework. That is what we mean by accrual basis of accounting, correct? Next part is with respect to materiality and aggregation. Materiality and aggregation. What does it mean? See here. First let me write, then I will explain. An entity shall present separately each material class of similar items. Further, entity need not provide a specific disclosure required by Ind AS if information is not material. If information is not material. If information is not material, then we need not require to disclose it. Now basically we need to understand the meaning of the first two lines. Suppose there are some assets P1, P2, P3, and these three assets are absolutely similar in their function, in their use, in their nature. So what we will do while preparing the financials, we will aggregate these items, correct? We will aggregate their carrying value. That is what we mean by materiality and aggregation. We will aggregate them and then we will put them as a separate item, separate line item. Are you getting my point or not? Three plants, these are of similar nature, so we have aggregated them and we have put them into a particular category. Similarly, let us say there are some other assets F1, F2, and both these items are of similar class. Again, I am going to aggregate them and I am going to put them as a separate line item, SLI, separate line item. And an entity shall present separately each material class. So it is a class, it is a different class, it is a different class, correct? But these classes are different, correct? And these will be presented separately. But important point is that such items which are falling in this class and which are of similar nature will be aggregated, then only we will present them separately, number one. But important point is that these items must be material. Let us say there is another class, S1, S2, but it is not material. So we need not require to disclose them, not material. So no separate disclosure is required. So we need not require to present them separately as a separate line item. Is it clear to you or not? So each class of material will be presented separately, but all those items which are falling in those class will be aggregated. That is what we mean by that. Next is with respect to offsetting. Offsetting means to net off. Offsetting. Now, in order to understand that, an entity shall not offset assets and liabilities or incomes and expenses, incomes and expenses, unless, so general rule is that we should not set off any assets and liability with each other. Similarly, no item of income or expense should be set off unless permitted by an Ind AS. Unless it is permitted by Ind AS, we should not set it off. For examples, measuring assets net of valuation allowance measuring assets net of valuation allowances For instance, obsolescence allowances on inventories and doubtful debt allowances on receivables are not considered offsetting. It is a general rule, general convention to show them at net value. Or, yeah, I should write is not offsetting. Correct? It cannot be treated as an offsetting. Similarly, an entity can present gains or losses on disposal, just wait, little bit of settings is required. On disposal, this is the only problem. On disposal of non-current asset, including investments and operating assets by subtracting or deducting proceeds on disposal by deducting from proceeds on disposal the carrying amount. Sometimes sentences are quite complex to frame. Carrying amount of the asset and related selling costs. It cannot be termed as offsetting, because when we will dispose an item, in order to compute gains or loss, I will have to subtract from the proceeds the carrying amount, and if the selling proceeds or the proceed amount is more than the carrying amount, it would be gain, otherwise it would be a loss. Correct? Likewise, comma, an entity may present net expenditure related to a provision. So, if we have created a provision for a particular expense, after meeting that expense, we can reflect the provision. So, again, it is not what we call offsetting. Also, an entity presents on net basis gains or losses arising from a group of similar transactions. For example, foreign exchange gains. Do you remember when you used to convert your foreign statements or trial balance in foreign currency into home currency? So, whatever net gain was there, you used to reflect it. You didn't used to what we call reflect the gains on a particular item. So, for example, foreign exchange gains and losses arising on financial instruments held for trading. So again, it cannot be considered as what we call a case of offsetting. Correct? So we try to understand with the help of a case study Is offsetting of revenue against expenses against expenses, comma, permissible in case of a company acting as an agent, and having subagents. Where commission is paid to subagents from commission received as agent. So, is it possible for the entity is acting both as agent and sub-agent, it receives the what we call commission, pays the commission. So, can the entity reflect it on net basis? Your response will be like this: offsetting or net presentation in the given case would not be appropriate as it would not reflect substance of the transactions. And would detract from the ability of the users to understand the transaction. Because entity is acting as an agent, and otherwise entity will not be able to reflect the substance that how much we have earned by acting as an agent. If we will simply reflect it on net basis, so it will kill the substance of the transaction. That is why better to reflect it on gross basis. Hence, commission received and paid should be reflected on gross basis, on gross basis. Correct? This is how you need to understand this case study. Boring, but can't help it. Sometime, in order to cover each and every aspect, sometime we have to take the boring aspects also. Can't help it in this regard. Then next, this was our numbering which I had put 13. Now I will put 14th. Frequency of reporting. Frequency of reporting, what we mean by it. Quite obviously, an entity will present a complete set of financial statement, of course, including the comparative information, at least annually. Each one of us know about that. So, here, nothing more to discuss, but I will have to write. An entity shall present a complete set of financial statements at least annually. Correct? However, when an entity when an entity changes the end of its reporting period and presents financial statements for a longer or shorter period, comma, an entity shall disclose the same So whenever we make alterations in our what we call reporting period due to some or other reasons, we shall have to disclose the same. That is the important point, correct? We need to disclose the reason, we need to disclose the facts. The point is this. Suppose if I put up a case study before you. The case study is like that. In 2021, entity S1 was acquired by entity P1 S1 was acquired by P1, correct? To align its reporting period with that of its parent, because now P1 will become the parent of S1, parent comma S1 changed its annual reporting period from from 31st December to 31st March. Consequently, S1's reporting period for the year ended March 21 is of 14 months. So entity will have to disclose this fact, and in the disclosure entity will have to put up a note like this. Entity will put up a note like this. First of all, entity will write reporting period heading. Then entity will mention the fact that in order to align entities reporting period RP with that of its parent, comma, entity changed end of reporting period from 31st December to 31st March. Financials presented for the year 31st March 21 is R of 14 months. R of 14 months. However, comparatives are of 12 months. Comparatives are of 12 months. This is the note we have to present. However, comparatives are of 12 months. So this is how you have to do. Anyway, we'll continue with that. It's a long standard. So in the next session, we'll meet you.